For the past 72 hours, this chart has dominated my screen. Something is profoundly off. An unsettling detail that no one seems to be addressing. A factor that entirely reshapes our understanding of Friday's market collapse. Initially, I doubted my own perception. I revisited the data, consulted alternative sources, examined multiple charts, but the figures remained stubbornly consistent. The longer I scrutinized them, the deeper my unease grew. I need to share this discovery with you. This line represents silver, Friday's catastrophic plunge, a 39% descent, the most severe single-day decline in contemporary market history. You are likely already aware. It's the dominant narrative. Every news outlet, every market commentator, every financial video. Silver imploded. Retail investors were decimated. Trillions in value evaporated. But here is the crucial piece everyone is omitting. This is what robbed me of sleep for 3 consecutive nights. This is the chart for SIL, the exchange-traded fund tracking silver mining companies, the actual enterprises that extract silver from the earth. Genuine mines, tangible production, real businesses employing real people and operating real machinery. This is where the narrative fractures. Historically, mining stocks are far more volatile than the metal itself. This is a constant. A 10% rise in silver typically fuels a 20% surge in miners. A 10% drop in silver usually triggers a 20% decline in miners. This correlation has been a market cornerstone for generations, one of the most dependable relationships in the commodities sector. On Friday, silver plummeted 39% from its peak, the most brutal collapse on record. Following the established pattern, mining shares should have imploded by 60%, perhaps 70%, maybe even 80%, yet they did not. The miners fell a mere 22%. I spent hours transfixed by this chart, grappling with a single question. How is this logical? The entire silver complex is disintegrating. Trillions are vanishing. Everyday investors are being obliterated. Meanwhile, the mining firms, the entities whose entire existence hinges on the price of silver, experienced only a modest tremor. It defied all reason. Then, the realization struck me. The smart money never sold. Pause and consider this. The institutions, the hedge funds, the pension managers, the family offices, the individuals overseeing billions, the teams with legions of analysts, the players with access to information you and I will never see. They did not panic. While silver was cascading down 39%, while retail traders faced margin calls, while portfolios were liquidated globally, the major players evaluated their mining holdings and declared, "We are holding." Why? Why would they retain mining equities while silver is in a death spiral? Why wouldn't they dump every share and flee for safety? There is only one plausible explanation. They possess knowledge that we did not. They understood the crash was not authentic. That realization consumed my night. If the collapse was fabricated, if the smart money anticipated it, if they positioned themselves flawlessly while retail was slaughtered, then evidence must exist. A trail must be left behind. So I began an excavation. What I unearthed filled me with a cold fury. Welcome to the hidden economy. If you're new to this channel, I specialize in revealing the true mechanics of markets while the mainstream focuses on headlines. Subscribe immediately because the analysis I provide is unavailable elsewhere. If this content delivers value, please press the like button. It signals the algorithm to share this with more viewers who need to see it. Now, allow me to present my findings. In my previous video, I detailed how the crash was pre-scripted. A precise 72-hour trap, coordinated from Tuesday to Friday. On Tuesday, a signal pointed toward a weaker dollar policy. Every global trader received the identical message. A weak dollar translates to stronger precious metals. The trade became self-evident. Hedge funds swarmed in. Retail traders went all in. Billions of dollars flooded one direction. By Thursday night, silver reached $121, a historic peak. Euphoria was universal. Conversations revolved around $200 silver, $300 silver, early retirement. Then, Friday morning at 6 a.m. before formal market opening, an announcement named a new Federal Reserve chairman, a known advocate for a strong dollar. The exact opposite of Tuesday's signal. Tuesday, weak dollar. Friday, strong dollar leadership. The same administration, contradictory messages, 72 hours apart. Traders who shorted the dollar on Tuesday were now compelled to repurchase it. Traders who bought silver on Tuesday were now forced to sell. A mandatory reversal, an engineered liquidation, resulting in 40% destruction within 6 hours. And inexplicably, throughout this chaos, mining equities barely budged. If you missed that breakdown, the link is in the description. It outlines the complete 72-hour timeline. But today, we delve deeper. Today, I expose the architects, the actual names, the documents, their recorded criminal histories. Let's begin with a term many may not know: spoofing. Spoofing is a method of market manipulation where a trader places substantial orders with no intention of executing them. Here is the mechanism. Suppose you wish to purchase silver at a depressed price. You enter an enormous sell order comprising thousands of contracts. To the market, it appears a massive silver dump is imminent. Observing this colossal sell pressure, other traders panic. They assume insider knowledge and begin selling themselves. The price falls. At the final moment, you cancel your fraudulent order. You never sold a thing, yet now the price is suppressed, allowing you to buy at a discount. That is spoofing. It is illegal. It is fraud. And for more than 10 years, the world's most prominent banks engaged in it within precious metals markets. They were apprehended. Between 2008 and 2020, 5 major banking institutions were convicted of rigging gold and silver markets. Not merely accused or investigated, convicted, found guilty, and fined hundreds of millions. Let me recount the charges. J.P. Morgan Chase, September 2020. The Commodity Futures Trading Commission issued an order citing manipulative and deceptive conduct, including spoofing spanning at least 8 years. Hundreds of thousands of fictitious orders intended to distort prices. The penalty? $920 million. The largest fine ever levied by the CFTC. It deteriorates further. The traders responsible did not merely pay fines. They received federal prison sentences. Michael Nowak, J.P. Morgan's head of precious metals trading, convicted of racketeering. The same charge applied to organized crime syndicates. Greg Smith, J.P. Morgan trader, convicted. Jeffrey Rufo, convicted. Christopher Jordan, convicted. These are real individuals with real names serving real prison time for operating a criminal enterprise inside one of the planet's largest banks. J.P. Morgan was not operating in isolation. Scotiabank fined $127 million. HSBC fined $76 million for 9 years of market cheating. Deutsche Bank fined $75 million. Their market rigging dated back to 1999, 15 years before detection. Morgan Stanley, also implicated. 5 banks, all convicted, all penalized. And what was the consequence? Not one ceased operations. Not one lost its trading license. They paid the fines and resumed business as usual. This is not speculative conspiracy. These are court records, government documents, public filings accessible to anyone. For over 20 years, these banks manipulated precious metals while regulators averted their gaze. They were only exposed due to whistleblowers. Even then, the fines were negligible compared to their profits. $920 million sounds substantial, but J.P. Morgan alone generated over $40 billion in profit in 2020. The fine was a rounding error. Now, the question that haunted me: do you genuinely believe they ceased? A bank pays $1 billion fine. Its traders go to prison. It admits to running an 8-year criminal operation, and then they simply reform? These are the same individuals, the same trading desks, the same strategies, the same profit motives. The fine was merely a business expense, a speeding ticket, a budget line item. Let me reveal what I uncovered in Friday's data. This is the COMEX delivery report from January 30th, 2026, the precise day of the crash. This document is published daily by the CME Group. It reveals exactly who is trading, who is closing positions, who is taking delivery. Most are unaware this report exists. It contains the entire story. Observe this column labeled Stopped. In futures parlance, stopped indicates contracts that were closed, positions that were exited. If you were short and you stopped a contract, you closed your short position and realized your profit. Now examine line 6061. JP Morgan Securities stopped 147 contracts. 147 contracts closed on the exact day of the crash. Let me clarify the implication. When you hold a short position in silver, you profit when the price declines. JP Morgan held short positions. On Friday, silver crashed 39%. At the absolute nadir, JP Morgan closed 147 contracts. They exited at the day's lowest price, securing maximum profit with flawless timing. Reflect on this. Thursday night, silver traded at $121, an all-time high. Every analyst was bullish, every headline positive. 12 hours later, silver cratered to $75, $46 erased in a single session. Yet JP Morgan knew precisely when to exit. They did not close on Thursday at elevated prices. They waited. They did not close mid-crash during a potential rebound. They waited. They closed at the exact bottom. The same bank fined $920 million for rigging silver. The same bank whose traders were imprisoned for manipulation. The same bank that admitted to hundreds of thousands of spoof orders. That bank, coincidentally, timed the precise bottom of history's greatest crash. Do you believe that was luck? Now observe other names on this document. Morgan Stanley, 31 contracts stopped at the bottom. Deutsche Bank, 58 contracts stopped at the bottom. HSBC, 60 contracts stopped at the bottom. Do you discern the pattern? The identical banks, the familiar players convicted of rigging precious metals, all closing positions on the crash day, all exiting at the precise bottom. This document is public, accessible on the CME website. I engaged in no hacking, no bribery. I simply examined publicly available data. The evidence is visible, plain as day. Upon my initial review, I had to reread it multiple times. I assumed I had misinterpreted. There must be an alternative explanation. Yet there it was, incontrovertible. The same offenders, the same timing, the same playbook. Now I comprehend why the miners did not crash. The smart money knew. The institutions knew. The funds holding mining stocks understood this was not a legitimate collapse. They recognized it was manufactured. They knew the banks required covering their shorts. So they held firm. They refused to panic. They witnessed the paper market incinerate while they retained physical assets. Miners down 22%, while silver fell 39%, is not coincidence. It is a deliberate signal. But the evidence continues. Let me reveal the CME's subsequent actions. CME Group operates the commodities exchange. They establish the rules, including margin requirements, the cash needed to maintain a futures position. On Friday, post-crash, the CME announced margin increases. Saturday morning, less than 24 hours later, they announced another round. Effective February 2nd, margin requirements are skyrocketing. Gold up 33%, silver up 36%, platinum, palladium, everything. Massive hikes across the board, a 36% increase overnight with no warning, following a hike just the previous day. Let me emphasize how extraordinary this is. Holding a silver futures contract requires a specific cash reserve in your account. A 36% margin increase demands 36% more cash immediately. Most traders lack idle cash, leading to forced liquidation. They must sell, regardless of desire. Higher margins equal forced selling equal further price declines. Now consider this alarming detail. If the CME aimed to curb volatility, they would raise margins before a crash, to cool an overheating market, to reduce leverage during frothy conditions. That constitutes responsible exchange management. Instead, they raised margins after the crash, then raised them again the next morning, then scheduled additional hikes. Analyze that sequence. Friday, silver crashes 39%, retail is destroyed. Friday night, CME raises margins. Saturday morning, CME raises margins again. Sunday, CME announces more hikes for Monday. They are not protecting investors, they are eliminating the survivors. The initial crash wiped out leveraged long positions. Now the margin hikes are exterminating those who held on, those considering buying the dip, anyone remaining. This is not risk management. It is a coordinated execution, and it conveys a critical message. A major entity is in peril. Ponder this. Why would the CME implement emergency-level margin hikes twice in 3 days? Why a 36% overnight surge? Because a significant player is underwater. Someone holds massive losing positions. Someone approaches default, and the exchange scrambles to shield the clearing system from fallout. Friday's crash was not mere selling, not profit-taking, not a standard correction. It was a forced liquidation bloodbath, engineered to rescue a major player at the expense of all others. Allow me to provide historical context, because what I will demonstrate proves this is not random, not mere market forces. This is a deliberate playbook. This is not its first execution. 1980, silver surged from $6 to $50, an 800% gain. Ordinary people built fortunes. The Hunt brothers attempted to corner the market. Silver dominated conversations. What transpired? The CME invented Silver Rule 7 overnight, banning leveraged purchases without warning. They altered the rules mid-game. No explanation, just new regulations that annihilated all long positions. Result? Silver collapsed from $50 to $10, an 80% destruction, obliterating thousands of investors. 2011. Silver climbed from $8 to $50, another enormous rally. Social media buzzed. Retail traders piled in. The silver squeeze movement emerged. What transpired? The CME raised margins 5 times in 9 days, an 84% total increase. Result? Silver crashed from $50 to $26, a 50% destruction requiring 13 years to recover. Now, 2026, silver soared from $26 to $121, the largest rally in history. Social media ignited. Retail investors were euphoric. What transpired? The CME raised margins before the crash, raised them again during the crash, raised them again after the crash. China raised margins simultaneously. A Fed chairman announcement was timed for maximum damage. Banks closed their shorts at the precise bottom. Result: silver crashes 39% in a single session, the swiftest destruction of the 3 episodes. 1980, 2011, 2026. Identical pattern, identical tools, identical playbook, identical destruction. Each time silver threatens to escape, each time ordinary individuals begin profiting from precious metals, each time the price begins revealing paper currency frailties, the identical script executes. Once is accident, twice is coincidence, 3 times is policy. This is precisely why smart money retained mining stocks. They have witnessed this narrative before. They know its conclusion. They know the price always recovers post-manipulation. The miners are communicating. They are not selling, they are holding. They are waiting because this crash was not real. It was paper manipulation, manufactured chaos, a synchronized assault to shake out weak hands and permit the guilty to exit at the bottom. The physical market confirms the truth. On Friday, while the exchange listed silver at $75, Dealers globally sold physical silver for $120 to $150, a 40% to 100% premium over the paper price. If silver were truly worth $75, why would buyers pay double? Why were coin shops depleted? Why were queues forming at every American dealer? The situation grows even more extraordinary. I must share a weekend development that reveals everything about the physical silver market's condition. Golden State Mint, among America's largest private mints, halted silver sales for the entire weekend. Their statement: not able to secure silver. I reiterate, one of the nation's largest mints could not procure silver. They ceased selling due to metal unavailability. The last comparable occurrence was during the COVID panic of March 2020, when the global system teetered on collapse, when panic buying engulfed everything, when the financial system neared the brink. That remains the sole other recent instance a major mint halted sales from sourcing failure. It has now recurred this weekend, immediately following Friday's crash. Contemplate the implications. The paper price claims silver is $75. Yet the physical market is so strained, so tense, so fundamentally fractured that a leading American mint cannot purchase silver to sell to clients. If genuine silver were available at $75, would Golden State Mint shut down? Would they reject customers? Would they publicly admit an inability to source metal? No. They would purchase every available ounce and sell at a premium. Their inability to find supply indicates it does not exist at these prices. The paper market and physical market have entirely decoupled. The paper price is fabricated. The physical price is reality. The chasm between them is no longer merely wide. It is shattered. Friday did not merely crash the price, it fractured the physical silver market, and the fissures are proliferating uncontrollably. Now, my perspective on forthcoming events. The short positions have been covered. JP Morgan exited at the bottom. Other banks followed. The manipulation has fulfilled its purpose. Weak hands are eliminated. Margin-driven retail traders have vanished. Leverage positions are liquidated. The market has been purged. However, they cannot control one immutable reality. The supply-demand equation remains unchanged. Silver is not optional. Solar panels require it. Electric vehicles require it. Every smartphone and computer globally requires it. Modern civilization cannot be constructed without silver. Demand is surging. Supply is stagnant. Friday's crash did not alter these fundamentals. It did not spawn new mines, reduce industrial demand, or modify any foundational factor. It merely transferred silver from weak hands to strong hands at artificially depressed prices. Now the physical market is failing. Mints are closing. Dealers are sold out. Premiums are exorbitant. This is not a healthy market. It is a market under extreme duress. I anticipate a violent recovery. When the reversal commences, it will be rapid. The same algorithms that propelled the decline will fuel the ascent. The same leverage that obliterated portfolios will generate fortunes on the rebound. The physical shortage will only intensify because each crash drives more individuals to purchase physical, to take delivery, to withdraw silver entirely from the paper system. Banks can manipulate paper prices, but they cannot fabricate physical silver. Presently, the physical market is screaming that a profound malfunction exists. I also suspect a more significant event approaches. The margin hikes indicate serious trouble for a major participant. You do not impose 36% margin hikes twice in 3 days unless a catastrophic blow-up is imminent. The coordinated timing signifies a global dimension. The physical market breakdown reinforces this. When a major mint cannot source silver, when premiums reach 50 to 100% over spot, when dealers refuse customers, this is not normal volatility. It is systemic extreme stress. Something behind the scenes is breaking. I have observed these patterns previously, in 2008, in 2020. Stress always manifests in peculiar arenas before the primary crash strikes. Currently, stress is omnipresent in margin hikes, in physical shortages, in the desperate timing of the Fed chairman announcement, in the synchronized actions of the CME and China. I believe a major market event is imminent within the coming months. The precise timing is unknown, but when I decide to exit completely, I will announce it here publicly, as I always do. Many will regret inattention. Let me conclude with this summary. 5 banks convicted, hundreds of thousands of spoof orders, traders imprisoned, and on Friday they closed their shorts at the exact bottom. The miners did not crash because smart money knew. The physical market did not crash because the paper price is fictitious. Golden State Mint halted sales this weekend due to an inability to source silver. The last parallel instance was COVID. The physical market is disintegrating in real time. 1980, 2011, 2026. 3 instances across 5 decades. Identical playbook, identical destruction, identical subsequent recovery. This is not a free market. It is a crime scene. The pivotal question, what will you do with this information? If this video enlightened you, I urge one action. Share this with someone who lost capital on Friday, someone who was liquidated, someone currently bewildered about their portfolio's fate, someone who merits viewing the evidence before their next decision. This is how truth disseminates, individually. Please comment below. Having seen this evidence, do you still trust this market? Are you holding? Are you buying? Are you exiting? I read every comment. Your feedback inspires further investigative content. If this is your first visit, subscribe now. Activate notifications because the next video may contain the warning that preserves your portfolio. You may also join my channel for detailed price action analysis. I provide regular updates on gold and silver to help you anticipate market movements. I will continue investigating. I will continue exposing. I will keep you informed. This is the hidden economy. The fraud is revealed. The evidence is unambiguous. The names are documented. They desire your panic. They desire your sale. They desire your surrender and departure. They desire your belief in the paper price's reality. It is an illusion. That is their victory method. That is their historical strategy. Crash the price, instill fear, purchase from the panicked at the bottom. Do not permit them to shake you out. Now observe what unfolds.